Okay, let's dive right into this explainer and absolutely upgrade your understanding of risk-based internal audit. If you're prepping for your CMA exam, you know this is a topic you literally must master. We're going to lock down those crucial marks by breaking these concepts down into clear, memorable pieces that you can easily recall when exam day rolls around.
Here's the roadmap for today's explainer. We'll kick things off with the reality of risk, then decode the RBIA concept, compare traditional versus risk-based approaches, break down 3 key advantages, and finally, wrap it all up with your core exam takeaway. Let's get into it.
Section 1. The reality of risk. Let's start by looking at the fundamental problem modern organizations are grappling with today.
So ask yourself this. Why is it that routine, traditional audits sometimes completely miss the massive threats that actually lead to corporate failures? It's kind of the foundational question, right? It really explains why the whole auditing profession had to evolve.
While risks are just inherently baked into every single organization, and success essentially depends on managing them well. In fact, a lot of recent corporate failures can be directly tied back to just really poor risk management by the executive team. Effective internal controls aren't just some administrative checkbox anymore. They are literally the ultimate defense for minimizing the fallout from business risks. Plus, remember that these controls provide built-in MIS reports. That means the summary of day-to-day transactions acts as a direct line of sight for senior management, keeping them perfectly in the loop.
Moving on to Section 2, decoding the RBIA concept. You can think of this as the ultimate next-gen software upgrade for those internal controls we were just talking about.
Now, for your exam, you absolutely need to commit this exact definition to memory. The Institute of Internal Auditors defines risk-based internal auditing, or RBIA, as a methodology that links internal auditing to an organization's overall risk management framework. Basically, it's not just about auditing financial controls in some isolated silo anymore. It's about tying the audit directly into how the entire company actually manages its risk appetite.
So, by following this methodology, internal auditors are able to draw 5 very specific conclusions. They make sure management is actively identifying and responding to risks, and that those responses are actually effective, but not, totally excessive compared to the risk appetite. They also verify that residual risks are fixed, processes are constantly being monitored, and that everything is properly classified and reported. This is a huge shift. It gives auditors a much bigger seat at the table because they're actively helping create effective controls.
And ultimately, doing all of this enables the internal audit team to give the board of directors the exact assurance they need across 3 key areas. First, the actual design and function of the risk management processes. Second, the management of those highly critical key risks. And third, the complete and accurate reporting of those risks.
All right, Section 3, traditional versus risk-based internal audit. Comparing the legacy system to this upgraded approach is incredibly likely to pop up on your CMA exam, so pay close attention here.
When you compare the two, the differences are night and day. Traditional audits run on a rigid standard cycle, whereas RBIA runs on business risk evaluation, meaning the really risky areas get covered first, and a lot more frequently. And the focus completely shifts too. Traditional methods just flag basic noncompliance, but RBIA actively hunts down risks that are either poorly controlled or even overly controlled. And when it comes to getting things fixed, RBIA facilitates a real consensus with management to get action plans implemented on time, instead of just creating friction and disagreements.
So, if you want the absolute core vocabulary to score high marks on this, just remember this one fundamental shift. Traditional internal audit is all about routine and compliance. Risk-based internal audit, on the other hand, is entirely focused on strategy and risk appetite.
Which brings us to Section 4, 3 key RBIA advantages. Understanding what RBIA actually is naturally leads us straight to the big 3 benefits it has over the old-school approach.
To make sure you can easily recall these advantages when you're under the pressure of the exam, I highly recommend using the CTS framework: consistency, transparency, and specifically. Let's break down exactly what each of these means. First up, consistency. Developing a consistent, really comprehensive approach to risk management makes it incredibly easy for an organization to adapt when conditions change. By syncing the audit schedule up with the risk management framework, the business can switch tactics rapidly whenever its objectives shift. It's all about staying agile. Next up in the framework is transparency. Taking a risk-based approach allows internal auditors to correctly identify threats right out of the gate. And that transparency gives management exactly what they need to put the precise, optimal internal controls in place for maximum performance.
It just provides a crystal clear understanding of the risks the organization is actually dealing with.
Finally, we have specificity. This means we are actively ranking and mapping risks so we can allocate our time and funds specifically to the areas that genuinely need the most attention. Sure, baseline compliance frameworks are totally necessary, but they don't account for every unique curveball a business might face. If you only rely on basic compliance, massive risks can completely slip under the radar. Specificity ensures you're building a unique, fully tailored risk management program.
And that brings us to Section 5, your exam takeaway. Let's distill all of this down into the single most critical paradigm shift you need to demonstrate to your examiners.
Here is your ultimate exam takeaway, the real game changer. Traditional internal audits simply provide control assurance based on routine checks, and that's it. But risk-based internal audit goes a massive step further. It provides assurance on the effectiveness of the risk management itself, in addition to that basic control assurance. You're literally guaranteeing to the board that the organization's entire risk management engine is actually working.
So, as you continue your study sessions and gear up for the exam, I want to leave you with this thought to chew on. If a risk isn't actively mapped to your organization's strategic business objectives, are you really auditing the health of the company, or are you just checking off a compliance box? Nailing that distinction is absolutely key to mastering risk-based internal audit.
Risk-based internal audit process, or RBIA, and lock down those 11 key internal audit standards for exam day. We know that as future cost and management accountants, mastering this stuff isn't just about passing a test, right? It's about understanding the actual framework that protects an organization's value. We're going to break this down so it sticks perfectly in your memory.
Here is our blueprint for today. We're breaking things into 4 logical chunks. First, the RBIA process plan. Then, the IAS Foundation covering standards 1 through 4. Next, IAS Execution for standards 5 through 8. And finally, IAS Technology, Governance, and Cost.
Starting off with Section 1, the RBAI process plan. Let's break this massive process down into 3 chronological phases. Think of Phase 1 as your initial recon mission. Before you even think about looking at a single control, you've got to define the objective and figure out the entity's risk appetite. You have to genuinely understand the business environment. Once you have that, you can move to Step 3, which is identifying the actual risks. From there, you prepare your audit universe and finally summarize those risks. Look, if you don't know the environment or what risks the company is actually okay with taking, your whole audit is literally flying blind.
Okay, moving to Phase 2. This is where we sort all that raw data into a highly targeted strategy. Step 1, we do our risk prioritizing and rating. Step 2 is a huge one. We filter out the acceptable risks. Basically, if it falls under the company's tolerance limit, we filter it out because we definitely don't want to waste our time there. Next, we categorize what's left and link them to specific audit areas. We assess the existing control environment, and boom, Step 5, we derive the residual risk rating. That residual risk, the stuff left over after controls are applied, is exactly where we need to focus all our attention.
And that brings us to Phase 3, execution. Armed with those residual risk ratings, we develop the actual audit plan and decide on the frequency. Then, we allocate our resources and set the schedule. Step 3 is absolutely non-negotiable. You must get approval from the audit committee. But remember, it's not just a one-and-done deal. It's a dynamic, continuous loop of reassessing the risk environment and updating the risk-based internal audit plan accordingly.
So looking at all of this, it really begs a pretty important question. What actual rules govern this entire massive process? I mean, who says the auditor even has the authority to do this? That perfectly tees up Section 2, IAS Foundation. These are standards 1 through 4, covering the absolute bedrock rules for the auditor's setup, engagement, and independence.
For your exam, lock this in. IAS 1 is the Internal Audit Charter. This is the most basic, extensive document there is for an internal audit. The whole audit plan and every single process must be based on it because it dictates the core objectives, the authority, and the responsibilities of the auditor. Bottom line, no charter, no authority.
Following right on its heels is IAS 2, the Internal Audit Engagement Letter. If the charter is the broad foundation, this letter is the specific blueprint for a single job. It defines the exact scope of a particular internal audit. The major takeaway here is that while this letter can totally vary from entity to entity, it absolutely 100% must be consistent with that charter approved by the board or audit committee.
I absolutely love this phrase pulled straight from the Institute's text for IAS 3.
calling the chief internal auditor the captain of the team. It's such a great visual, reminding us that the chief auditor must lead, ensuring that every single examination of transactions is objective and completely free from any kind of bias.
Grouping these two together for speed, IAAS 3 demands absolute independence, integrity, and objectivity. You simply cannot do this job if you're biased. Meanwhile, IAS 4 is all about proficiency and due professional care. The source text literally calls internal audit a value-added function. And how do you add value? By getting the proper, ordinary, and professional education and applying maximum professional care to everything you do.
Moving right along to Section 3, IAS Execution, Standards 5 through 8. This chunk is all about how the work is actually conducted and communicated.
IAS 5 covers using the work of an expert. Look, modern business is insanely complicated, right? Sometimes the chief internal auditor has to bring in outside help for specialized areas. But here is the critical rule for the exam. If you use an expert, you must maintain the utmost confidentiality. And more importantly, you can't just blindly trust them. The chief internal auditor is strictly responsible for verifying the reliability of the information that expert provides.
Next in the execution pipeline, we have IAAS 6, Quality Assurance and Continuous Improvement. This means the chief internal auditor has to actively supervise the team, ensuring continuous professional development and making sure the quality of the audit is assessed both internally and externally. Then there's IAAS 7, Communication and Confidentiality. This mandates regular updates to the audit committee or board. Plus, a huge point to remember, any communication to parties outside the entity requires proper sanction from the entity's authorities. You don't just go chatting with outsiders.
And wow, does this bring things full circle? IAS 8 is literally titled Risk-Based Internal Audit. This is the exact standard that mandates the review of the entity's risk management and internal control systems. This standard right here is the rule that demands the execution of that entire 3-phase, 15-step RBIA process we covered at the very beginning of this explainer.
Let's tackle our final chunk, Section 4, IAAS Technology, Governance, and Cost. These are standards 9, 10, and 11, and they deal with highly specific, modern corporate demands.
Now don't get tripped up on the exam between these two. Contrast IAS's general requirement to review risk management with IAS 9, which is technology-driven internal audit. Standard 9 gives an explicit mandate to understand the IT environment to catch potential risks creeping in. It also gives the green light for the auditor to actually use information technology to analyze their audit data.
Next up is IIAS 10, Enhancing Governance through Internal Audit. This standard really elevates the auditor's role way beyond just checking numbers on a page. The audit activities should evaluate the actual governance procedures of the entity, and the team is expected to provide proper recommendations for improvement. This standard proves that internal audit is a deeply value-added process for the company's whole governance structure.
And finally, IAS 11, Internal Audit of Cost Records. This is absolute bread and butter for us CMA students. It strictly mandates that the internal audit must include the cost records and the cost accounting system. And crucially, the chief internal auditor must report on the effectiveness of that system directly to the audit committee or director board, always building off the foundation of the charter and the engagement letter.
So we've covered the whole RBIA action plan and the 11 foundational standards. As you're going over your notes tonight, ask yourself, are you just going to try to memorize a bulleted list, or are you actually seeing how these 11 standards seamlessly direct every single heartbeat of a protected company? If you master how this flow connects, you won't just ace the exam, you'll be totally ready to lead the team out in the real world.
We're going to look at how a massive historical financial fraud actually birthed a completely bulletproof system of corporate defense. If you've ever wondered how modern businesses build their internal fortresses to protect against catastrophic failure, well, you're in the right place. Let's get started. To really understand the defense, we first have to understand the disaster. Picture this. It's 2009. The business world gets completely rocked by the infamous Satyam scam. Now, what made this so terrifying wasn't just the sheer scale of the financial fraud committed by management. It was the total, absolute failure of the statutory audit process to actually detect it. The mechanisms that were supposed to keep the company honest, they had massive blind spots. Millions of dollars were compromised, and trust was just completely shattered. So this shocking event? It served as a massive wake-up call. It practically forced Indian regulators to completely rethink their approach to corporate governance. They started looking worldwide for best practices. studying rigorous frameworks like the Sarbanes-Oxley regulations in the US, the Turnbull guidance in the UK, and JSOX in Japan. The goal was crystal clear. India needed to raise its standards to match these global financial fortresses, paving the way for a brand new era of internal financial controls. All right, so here is our roadmap for today. We've just covered the SATYAM catalyst. Next, we're going to define internal financial controls, look at the statutory rules of IFC, unpack the internal audit process, go over evidence and reporting, and finally, wrap up with some practical appendices and tools. Section 2, Defining Internal Financial Controls, or IFC. Before we get completely lost in the heavy auditing standards, we need to ask, what does control actually mean in a corporate financial setting? Well, according to Section 134(5)(e) of the Companies Act of 2013, internal financial controls are the policies and procedures a company adopts to ensure orderly business conduct. But let's translate that legalese into plain English, right? The ultimate goal here is simply protecting your assets and catching errors or frauds before they explode into a 2009 level crisis. It's about ensuring your accounting records are accurate, complete, and reliable every single day. Moving on to Section 3, Statutory Rules of IFC. Definitions are great in theory, but the Companies Act of 2013 distributes responsibility through a comprehensive matrix to give these rules some real teeth. Section 134 makes directors of listed entities explicitly state their controls are adequate. Section 143 and Rule 8, they pull in the auditors to report on these controls for all entities. Section 149 puts the onus squarely on independent directors to ensure risk management is robust, and Section 177 empowers the audit committee to basically scrutinize everything. By spreading this responsibility across directors, auditors, and committees, the law ensures there are absolutely no blind spots. Section 4. The internal audit process, specifically looking at standards IAS 21 through 27. So, how do professionals actually enforce all these controls? They use a detective's toolkit, specifically the Category 2 Internal Audit and Assurance Standards created by the Institute of Cost Accountants of India. Let's look at the first half of this workflow. It isn't just random checking. It is a highly logical, step-by-step investigation. You start by planning the audit, you sample the massive ocean of data, and then you rigorously evaluate those samples. Let's break down each of these standards. It all kicks off with IASAS 21, Internal Audit Planning. This standard strictly dictates that the chief internal auditor absolutely cannot prepare an audit plan in isolation. Think about it. A rogue auditor acting totally alone is actually pretty dangerous to the process. Instead, proper planning has to be a byproduct of consultations with different stakeholders, with the audit committee playing a highly significant role. It's essentially a collaborative mapping of the battlefield before the investigation even begins. Once that plan is set, we move to IAS 22, Internal Audit Sampling. The source text puts this perfectly. Auditing is a process which is based on sampling. Imagine a massive corporation with millions of transactions a year. It is physically impossible to check every single receipt and invoice. Therefore, this standard provides the framework for selecting an audit sample from that broader population, making smart, statistical sampling the absolute backbone of uncovering the truth. Now, after you pull your samples, you don't just stare at them, you interrogate them. This brings us to IAS 23, Analysis and Evaluation. The internal auditor is required to use significant and sufficient analytical procedures. This means looking at trends, investigating unusual fluctuations, and testing relationships within the data. It's all about turning those raw, sampled numbers into a concrete, defensible conclusion about the health of the company's controls. Section 5. Evidence and Reporting Standards. We are moving into the final phase of the investigation now, securing the proof. If we think back to the SATYAM scam, we know for sure that verbal assurances mean absolutely nothing. IAS 24 dictates that capturing audit evidence is highly relevant, requiring the chief internal auditor to design specific procedures to get that exact evidence. And IAS 25 backs this up by enforcing strict standards for audit documentation. Look, without airtight documentation and tangible evidence, an audit is completely useless in preventing fraud. If it isn't documented, it literally didn't happen. All right, so once all that documented evidence is compiled into a report, Where does it go? IAS 26 covers disclosure and reporting, and it contains a truly brilliant safeguard. The internal audit report must be addressed directly to the chairman of the audit committee or the board of directors. It ensures that vital findings, especially anything regarding fraud or massive control failures, completely bypass middle management and go straight to the absolute top of the corporate ladder. No one can bury the report. Here is the really crucial part, though. Handing in the report, that is not the finish line. AIS 27 mandates monitoring progress. The responsibility of the chief internal auditor does not end with the completion of the audit. They have to actively monitor the actions taken by the entity based on their recommendations and observations. An audit is only as effective as the follow-up. If the company doesn't actually fix the vulnerabilities that were discovered, well, the entire exercise was just a waste of time. Finally, Section 6, Appendices and Final Tools. To make absolutely sure everything is applied consistently, the Institute also provides practical templates. Alongside the standards and a glossary, you'll find these 4 vital appendices: a model internal audit charter, a model internal audit engagement letter, an illustrative internal audit plan, and an internal audit report template. These act as a ready-to-use framework so professionals don't have to reinvent the wheel for every single engagement. They can hit the ground running with standardized, structurally sound documents. And that brings us to the end of today's explainer. But before we wrap up, I want to leave you with a thought to really chew on. Think about everything we've covered today, from the devastating Satyam scam to those rigorous step-by-step IAS standards. If a massive 2009-style crisis targeted your organization today, are your internal financial controls truly robust, meticulously documented, and defensible enough to actually catch it? Corporate defense isn't just a one-time project. It's a vital, ongoing commitment to truth and transparency. Thank you so much for joining me today, and keep learning.